Welcome to my channel. Here's our first story. In the 1600s, a single flower was worth more than a mansion, and then in 1 week, the entire Dutch economy collapsed. This is the story of Tulip Mania, the world's first financial bubble. Picture Europe in the early 17th century. The Netherlands was rich, powerful, and trading across the world. And then in 1634, a new obsession arrived: tulips. Exotic, colorful, and fragile, they became the ultimate status symbol. And not just any tulips, mind you, but certain ones. The type with wild patterns and vivid colors, especially red and yellow tulips. They were extremely rare, expensive, and only the richest could afford them. So if you wanted to prove you were elite, you needed those kinds of tulips. And where did these tulips come from? The Ottoman Empire. From Turkey to Amsterdam, they were transported across Europe through an extensive trading network. Some say the first tulips arrived in Vienna. Others claim it was Paris. But everyone agrees, the Netherlands took the flower global. And no one knew this craze would go supernova. For the first few decades, tulips weren't much of a problem. Yes, they were a luxury good, but hardly a concern. That changed with two key factors. One was a basic supply issue. There were simply too many tulips for too few buyers. And this isn't because the Netherlands planted more tulips. In fact, the opposite happened. In 1634, the bitter cold winter almost destroyed every tulip in the country, and when supply shrank, demand didn't. Prices skyrocketed. Then factor in another trend, namely risky investing. The 1600s were an age of exploration. New lands were being discovered, spices were becoming common, and silk, porcelain, tea, and tobacco were transforming European life. This period also sparked groundbreaking innovations. The microscope, telescope, vaccination, and banking were invented during this time, and by the 1630s, investors loved high-risk, high-reward ventures. Combine that with the frenzy around tulips, and what happened next was inevitable. Tulips became speculative assets. People weren't buying them to beautify their garden or decorate their home. They were buying them for pure profit. Merchants, bakers, even servants were getting involved. And suddenly, tulips weren't just flowers. They were investments. Let me explain. Say you owned a bakery, but instead of selling bread, you decided to buy 20 tulip bulbs. For $100, then sell those tulips for 10 times the price. Now you're a millionaire baker. And yes, that sounds crazy, but that's exactly what happened. Throughout Europe, people quit their jobs to focus full-time on tulip trading. And it wasn't just about making money. It was about showing off, outdoing your neighbors, and making a statement with the rarest, most valuable tulips. And the craziest part, it worked. People saw others flipping tulips for big profits, so they joined in. And since no one really understood how much a tulip was really worth, they just compared prices. The market didn't care about color, pattern, or rarity. They only cared about one thing: how much someone else was willing to pay. Now you might think this is absurd, but let's be real, we do the same thing today. Sure, stocks represent ownership in a company, but that doesn't mean stock prices reflect the true value of a company. Investors care more about other investors buying their stock and pushing the price up. Crypto is even more obvious. Most people aren't using crypto for transactions or payments. They're gambling on its price appreciating. And with NFTs, well, that's just a meme on a blockchain. And none of this is new. For centuries, people have traded dreams, hype, and the promise of something better. The Tulip Mania was just the beginning. By 1636, tulips were taking over Holland. Gardens were filled with bulbs waiting to bloom. And since tulips couldn't be traded while growing, contracts had to be written, basically betting on what the flower would look like in spring. And these bets got wilder by the day. Contracts were based on the size, color, and even the number of petals on each flower. Of course, nobody checked on these tulips. They were just traded like stocks, passed around and speculated on without anyone really caring about the flower itself. Meanwhile, tulip farmers across the country focused on quantity, not quality. They planted hundreds of thousands of bulbs in massive fields across Holland. It became a nationwide obsession. And then suddenly, everything stopped. On February 1637, the buyers didn't show up. Auctions that were once filled with bidding wars suddenly went silent. In a matter of days, the entire market evaporated. Sellers realized that there were no more buyers left. Families who thought they were millionaires on Monday were bankrupt by Friday, like Thomas Iperman, a 28-year-old Flemish painter. He invested his savings in tulips, and within days he made enough money to buy castles, palaces, and art collections. Suddenly, he was flat broke. Or take the story of Balinese Beek, a young widow who reinvested her profits and lived off her future gains. Well, there were no future gains. She lost everything. And she wasn't alone. Fortunes were erased in a matter of days. Shops were shut down. Farmers abandoned their fields. Entire families were wiped out. It was one of history's fastest and most dramatic crashes. But oddly enough, it wasn't the end of the world. The Dutch economy didn't collapse completely. Trade continued, cities survived, and tulips became just flowers again. Although the crash destroyed countless lives, it didn't destroy the Dutch economy. Government officials realized the crisis was caused by speculation, not the underlying economy. So they just let the market correct itself. But this wasn't easy. Not only was the Tulip Mania one of the world's first speculative bubbles, it was also one of the hardest hit. A third of all tulips planted failed to bloom that year. Even after the bubble burst, some people held on to their flowers, hoping they'd still be valuable. But eventually, reality set in. The government intervened, arrested speculators, and banned future contracts on tulips. And that should have been the end of it. But here's the thing. The Dutch didn't learn anything. The truth is, Tulip Mania wasn't just about flowers. It became the first great lesson in human economics. We don't just trade value, we trade stories, dreams, and hype. And when the story breaks, so does the market. The Dutch continued trading in the exact same way that caused the crash. They just picked different assets. Next, it was spices, then real estate, then stocks. And in modern times, we see this all the time. .com companies popping up, getting hyped, going public, and collapsing in on themselves. Or cryptocurrencies skyrocketing overnight, only to crash when investors realize it's just code on a computer. And with NFTs, it's even simpler. It's just a link to an image online. Yet people spend millions on digital images because someone else bid higher. And this brings us back to the question, why do we do this? Why do we invest in things that don't really have value? The answer, it seems, is simple. We follow the money. During the Tulip Mania, people were drawn to the possibility of fast profits even if they didn't understand the market. Today, it's the same story. When you see others making money, you want in on the action too. So you buy whatever they're buying, whether it's stocks, crypto, or art. After all, if others are investing, it must be okay, right? Wrong. As Henry Ford once said, beware of little expenses. A small leak will sink a great ship. And that's exactly what happened with tulips. Small leaks in the market grew into a tidal wave, wiping out fortunes and ruining lives. So remember this story. The next time you see an investment that doesn't make sense, you need to resist the urge to join in. Don't chase returns. Ask questions, do diligence, and stick with what you know. Otherwise, you could be swept up in the next mania. And trust me, they're out there. Just ask the South Sea bubble, the Mississippi bubble, or the .com bubble. All right, now a strange twist to this story. After the tulip bubble burst, some smart investors actually profited from the crash. Here's how. In the midst of the chaos, one man stepped in, Daniel Lefort, an apothecary and businessman. He noticed that while the tulip market was crashing, the real estate market was booming. So what did he do? He sold his tulips and bought property. Years later, when the real estate bubble burst, he did the same thing again. He sold his buildings and invested in tulips. And when the tulip market recovered, he made a fortune. And this is a fascinating strategy known as counter-cyclical investing. Instead of investing in a booming market, you invest in markets that are going down. And this can be incredibly profitable. But it also takes a lot of courage, timing, and self-control. After the tulip bubble burst, they went on to cause 3 more financial crises in the 1600s. In 1648, the Dutch East India Company stock crashed. In 1660, the Dutch silver bubble burst. And in 1673, the second tulip bubble appeared. Yep, it happened again. And the Dutch never seem to learn from their mistakes. And if you want to learn from yours, watch my video, Pay Raise Paradox. You won't regret it. See you on the next video.